We've talked a lot in recent years about the future of artificial intelligence. Questions such as, how will tech companies justify the tens of billions of dollars that they're spending on chips and data centers? And what new applications will emerge that will change the way people work? What's often missing from these conversations is a recognition that, in some industries, AI has been in use for many years. This is particularly true of financial markets. Banks and investment firms have for decades used computing power to develop large statistical models that spot patterns and anomalies in markets and trade on that information. These are not the large language models that have captivated so many since OpenAI launched its chatbot, ChatGPT, in 2022, but they still might offer us some insight into how self-teaching computers have evolved and where they're heading. So this week on The Big View, we're going to talk about AI in financial markets. It's what we do at Reuters Breaking Views. We tap our best sources around the world to bring you fresh insights into the biggest stories in global business and finance. I'm your host, Peter Thalas. To talk about this topic, I've invited Gary Collier onto the show. Gary is the Chief Technology Officer of Man Group, the investment management firm. He's responsible for all technology and data science across the firm, which started out trading sugar and rum in London in 1783. Gary, who joined Man in 2001 as a software engineer, was previously CTO of Man AHL, the firm's quantitative investment unit. Gary Collier, welcome to The Big View.
Hello, very pleased to be here. Thanks for having me.
So I want to start with a quick recap of sort of technology in the investment world. I mean, a lot of the current debate around AI is talking about how this technology could be applied in future. But obviously in finance, aspects of this technology have been in use for a long time, and Man Group has been using this for many years, for several decades, I think. So how do you sort of think about how the technology has evolved and kind of where we've got to now?
Yeah, it is interesting. It's an interesting question. It's interesting to look back at history, and you're of course correct that quant investing has now been around for some time, and technology has always been like interwoven with that. And what we've seen, I guess, is this relentless steady growth of tech applied to finance and to quant finance. And putting that side by side with the history of AI, that makes for quite an interesting view as well, because the history of AI has seen some really volatile bursts of activity. And take, for example, 1987, when Man AHL, that was founded back then, but that was at the start of what was regarded really as the second AI winter, when it was becoming unfashionable to talk about AI. But in a lot of ways, and you allude to this when you talk about the firm, AI is really nothing new to us here. It's been part of the toolbox for a long, long time. And we really started to explore it in the noughties. And towards the end of that decade, we began to build out some fairly serious compute clusters, invest more in data. And of course, it's that trio of compute, data, and models that has tended to propel growth. And that led us to explore a lot of different techniques across many aspects of the investment process, helping us deal with data, helping us to build alpha signals, to construct portfolios more effectively, to execute more effectively. But I think it's also fair to say that the bulk of this was related to and driven by the quant businesses in particular. And a bit like the gradual rise in tech, then over time we saw the gradual rise in AI in quant too, and we get to the point, or maybe got to the point at the end of 2022, where we could say that using AI was very much BAU for us. It was another established part of the tech and investment toolbox. But of course, things changed at end of 22, start of 23, with Gen AI hitting the scene. And I think one of the important differences then was hitherto you could rely on quant to be at the forefront of, or the keenest users of tech. Gen AI changed things, it mixed it up a bit. discretionary investors started to see the utility, as did other parts of the firm, legal, for example. So an interesting journey overall, I would say.
So how would you, thinking about the quantitative investing part of it, you mentioned it sort of started back in 1987.
Mm-hmm.
What was the application? What was the insight of the use of technology at that point, and how has that sort of evolved? I mean, even before we get to the whole sort of Chat GPT, sort of large language model part of it.
Yes. So back in 1987, and that was, even though I've been with the firm a long time, that was still seriously before my time with us. But I think if we recall the capabilities of computing back then, in desktop computing end user computing was starting to become a thing. And really the genesis of quant investment at that point was mathematical methods, statistics being brought to bear with data, and that used to inform trading decisions. That was how things kicked off, with a small number of at the time what we would regard today as like relatively simple models.
And then that sort of evolved as, I mean, you talked about computing power and data sort of being the two of the big inputs. Then that evolved as computing power improved, and as, I guess, the amounts of data sort of increased.
Yeah, that's right. Everything has grown. The amount of data, the different types of data has increased. The amount of compute that we've had at our disposal, that's increased. The quality of the software, we've seen a very big growth in mathematical libraries, statistical libraries, machine learning libraries, things that you would have to build yourself at the time or pay a lot of money for. A lot of that has become commoditized. So I often think of this in terms of stratas of capability, from, say, compute down at the bottom through platform capability on top, like lifting the capabilities of what we can do.
Yeah, I see. And talk to us a little bit, just before we get into the more recent applications. I mean, just a little bit in terms of this business AHL, which I think McMahon has sort of owned, or at least had a majority stake in, for something like 25 years. You know, it tends to get in sort of journalistic shorthand, it gets described as a, trend follower and things like that. I mean, how should we think about what the technological aspect of what something like AHL does? What is the use of the technology there?
Yeah. I think calling AHL a trend follower, yeah, perhaps that was true of a time. We're much more diversified now, and for a time had the motto any model, any market, and really that was the ethos, bringing many different types of techniques to bear across markets globally. Of course, it's a very, very technology driven part of the firm. It's hugely reliant upon very deep, complex, rich platforms, both of which provide the raw compute, but also using an awful lot of open source and Python. We decided, and this proved to be a very good decision around 2010, to double down on Python as the language that we would use for quantitative research and trading. It brought lots of different professionals together, be they technical professionals or investment professionals, into this highly collaborative single coding workspace. And now we use somewhere between 1,500, 2,000 open source packages, bring that together with our own IP, our own expertise, to build both the platforms that allow us to perform quantitative research. Think of it as a bit like a financial data and technology laboratory.
Mm-hmm.
And that's really, I think, part of the core of the success.
And how should we think about the sort of the competition in this? I mean, it feels like this is a sort of a part of financial markets where there's a sort of constant evolution. People are discovering, relationships or anomalies or inefficiencies, and then using them to, generate returns, generate alpha. But then others come along and sort of, and that disappears, and then you have to sort of move on to something else. Am I thinking about it correctly?
Yeah, I think you are thinking about it correctly. And often how I view things here, it's like the constantly having to walk hard up an escalator that's going down. It's by nature, finding and preserving alpha is hard. I guess definitionally it is so. If it wasn't, it wouldn't be alpha. And to do that, of course, we need to bring a number of different things to bear. We need to look at the number of markets that we can trade. We need to be constantly exploring the horizon of tradable markets. We need to be looking at data sources, and we spend a lot of time scouting, assessing, onboarding different sources of data that might give us some type of data, some type of information advantage. And of course, we're constantly researching new models as well, new techniques that we can bring to bear on data that is relevant to the markets that we want to trade. And that trio of capability is something we've always got to be working on, and working on hard, if we want to make sure that we're constantly going up that escalator, which is forever going down.
Yeah, that's a great analogy. So just come back to sort of the more immediate past. I mean, obviously, a lot of explosion, as you know, a lot of explosion interest in AI over the past few years has been around this sort of large language models. How do you use large language models inside Man Group? What if any sort of tangible benefits can you point to?
Yeah, a number of different areas. I'd see an awful lot. Let's start with incremental value add across different roles and different job functions. An awful lot of toil reduction there. Now, arguably, you could say, well, that's not as exciting as revolutionary change, but it's still quite real. And I like to think about that as something akin to the elite athlete model, where an elite athlete might look at small improvements across many parts of their game. What we're looking at here are very small cumulative improvements across different aspects of the firm's operating model. We built out a tool quite early on called Man GPT, and what that does, that allows us to interface to a number of different large language models, be they internal models or external cloud-hosted models. Well over half the firm use that technology now on a monthly basis, and that's used for simple use cases, much that you might use regular chat GPT for, drafting a job spec, through programmatic use cases, building out chatbots or things to automate workflows. Coding, of course, that's very important too, as lots of people within the firm code, not just engineers in my team, but overall as a firm, we talk about Python as the second most used language after English, and that's true. We've experimented with lots of coding co-pilots. I think, frankly, found some of the initial hype around the first wave to be a bit overblown. For basic tasks, fine, but more advanced stuff that requires that contextual awareness of our code base and the sorts of things we're doing, somewhat lacking. But the next generation here is showing much more promise. And that's the kind of bread and butter stuff. In terms of specific examples that are affecting the investment processes, it's been interesting, as I said, to see the thing that was a bit different this time in terms of uptake of tech, with the discretionary investment teams being like as interested as the quant teams. And the focus there has been very much around information extraction, information summarization, customizing information flow for individual portfolio managers, starting with broad brush filings, for example, that might be applicable to lots of different companies, pulling out salient information that's relevant to a particular PM and the names that they're interested in, and then augmenting that with like specific information and building up things that make their life easier. But then flipping back to the quant space, some of the things that we're doing there, I think, is particularly exciting, because that might have previously been considered this is a innately like creative endeavor. Nothing for tech to see here in terms of idea creation and hypothesis generation. But I think that's no longer true. And we've got a couple of projects here that I'm particularly excited about. One of them we call Alpha Assistant, and that's very much like almost like your traditional co-pilot, but aligned to the needs of quant research, helping them convert hypothesis into code, into backtest, into simulated returns. And the second project in this space is called Alpha GPT, and that is trying to properly disrupt this creative quant process. I mean, fundamentally, if we think, what does tech do? How does it add value? Well, we aspire to understand workflows, then automate those workflows. And if we think that we've talked about applying tech to investment, and tech has allowed us to systematize the investment process in a fairly deterministic fashion, I suppose, the next level of thinking is, how do we systemize how we build systematic strategy in the first place? And if we begin to break that down and bring some of the new advanced reasoning models to bear, then maybe we can start to do just that.
That's fascinating. So are you then, does that sort of involve going back and looking at what you as a firm have done in the past and trying to sort of distill it into some sort of model or some sort of process that can then produce new strategies?
Yeah, it's looking at like what is involved in the creative workflow. How do we come up with strategies? And parts of that could be, for example, looking at research documents, looking at academic documents. And if we've got the capability to more readily and like easily consume and look for ideas amongst like large numbers of documents, large numbers of text, that's something that can help like seed the idea generation process. And then, of course, I mean, agentic AI is, I guess, hot topic at the moment. But thinking about how we can like empower machines to start to automatically distill ideas, apply those ideas, perhaps not just to the instruments which are talked about in the paper, but to other instruments, like automatically run backtests, automatically bring to the fore and like nudge our humans to look at certain things. So that's the sort of thing that we're thinking here. And it's early days, but I think we're showing some significant promise already.
I really want to come back to the automation question and the limits of automation. But first, I just want to talk a bit about the sort of the financial aspect of this in terms of investment. I mean, we spend a lot of time breaking views, trying to, looking at what kind of investments are being made and trying to discern sort of what the returns might be and how companies are sort of benefiting from this. And particularly, obviously, what we've seen in the last few years has been this, I think, really, you could call it an arms race between the big tech firms, throwing vast sums at chips, vast sums at data centers. And I guess I wonder how you sort of think about that from your perspective, and particularly sort of then from what's going on in markets and in finance. Has there been a sort of similar surge of investment that's going on? Are you having to go back to your CFO constantly to beg for new approvals to make new investments?
No, you made me envisage begging to my CFO. That made me smile. Short answer: no, I'm not. How I tend to view this, a bit like previous step changes in capabilities, previous new game-changing tech, very much playing the long game rather than the sort of lurching around and doing stuff ad hoc. Talk of arms races. Well, thinking about hype, there's certainly loads of hype about this, but in some ways I'd separate the hype into two hype cycles. And there's the big tech hype cycle. And of course, you're right, the amount of money being invested in chips and in data centers is quite staggering. But I'm not sure that's wholly connected at the moment to the real world hype cycle. And I think for actually quite a few people in the industry, possibly some way into the trough of disillusionment, so to speak. And certainly if you look at some of the research, some reports are suggesting that the themes, the areas that were highest hope, general productivity gains, have actually seen the least ROI of any experiments that have been done. And I'm connected with quite a few peers in the industry, particularly in London, and AI is not getting quite the same airtime around the dinner table that it was 12 to 18 months ago, where you could guarantee that it would monopolize the whole conversation. And perhaps that's because that the big tech expectation that's been set and the impressiveness factor of apps such as ChatGPT hasn't translated as quickly as people would like into those killer apps in the workplace. So I don't think there's necessarily an arms race in effect. I wouldn't go quite that far, but there's still a lot of interest. There's still investment and still belief that there's a strong potential for the future of the tech. But as I said, very much in my view about playing the long game here.
Yeah. And then when you think about your, I mean, I guess we've seen this, we've seen the developments recently with this Chinese model DeepSeek, which seemed to be able to do lots of things that other models were able to do. It appears, nobody's quite sure, it appears sort of a lot less investment and a lot less sort of processing power. And I guess we had a columnist of ours was talking about this on the show a couple of weeks ago. This sort of, it's almost like sort of religious debate between the people who think of AI as this kind of, amazing revolution that, and which kind of justifies all the amounts that are being spent on it, and other people who think about it in a more sort of a more contained and more sort of specific applications. But I guess the question I'm really getting at is to what extent do you, or where do you stand on this question of the relationship between, between data and computing power, which I suppose in both terms is sort of money, and then results. Is there a sense that you have to spend as much as your rivals are spending in order to keep up, or is it a bit more complicated than that?
I think it's a bit more complicated. I'm really not sure that this is a case of deepest pockets necessarily lead to the best innovations. And you mentioned DeepSeek, and I think that's a good example of that. Notwithstanding, people might claim, various things about how true that was in terms of genuinely training at such lower cost, but that aside, I think the point there is that scarcity itself is often a driving force in innovation. Now, if you're training your own models from scratch, and even if you've got some fairly innovative techniques such as the ones that DeepSeek came up with, then it's clearly still pretty capital intensive. But I don't think many organizations are doing that or need to do that. I think organizations that have claimed to do it in the past, some of them have perhaps not represented quite accurately what they've been doing. And in any case, what they did was probably overtaken by general purpose models that came out soon after. And my ethos here around efficient innovation, it's very much a continuation of the ethos I have with technology in general, and like how to get the most out of it, how to be efficient, how to be agile. And often I think the best approach there is to combine outward looking smart engineers with open source code. I mentioned earlier that we're using somewhere between 1,500 to 2,000 different open source packages. And I think that combination, small, cohesive, well-formed software units, thinking about how you wire that up, how you bring your own IP to bear to solve the problem, which powerful Gen AI services that are exposed as APIs via cloud, how you can bring all of that together. I think that's a better recipe for success than just thinking about like throwing money around to buy the latest chips, the latest hardware.
Yeah, that's very helpful. So I want to come back to that automation question, that sort of that idea you were talking about earlier, and just to kind of ask, where do you see the limits of automation? I mean, there's a lot of processes that can be automated, a lot of trading sort of execution functions that can and do happen automatically, and then you were sort of you were talking about the possibility of actually sort of recreating in technology some of the processes that would have happened, the more creative processes that would have been done by humans. I guess in this world, sort of, what do you see ultimately as the role for humans? Where do they fit into all of this?
Yeah, that's a good question. I think you talk about automation and decision making, and you've named a bunch of different parts of the investment process. So I think first thing to recognize is that for a long time we've been living in this world of complexity, more data, more signals, advanced optimizers, increasing speed of responding to new information. And so the ability of humans to pre-validate every machine decision in the systematic quant space in particular, that's already pretty limited, already impossible. So human decision making here, where does it go into? It goes into the model creation, it goes into the system construction. Now, I suppose quant trading has often been described as black box trading, but at least in the firm here, that's never really been true. And every tiny stage of our decision-making processes, right from data through all of the alpha signals, portfolio optimization, trading, etc., we record rich diagnostics and use those for explainability. And I think maintaining explainability to humans is key, in my view. And I think that's probably the only viable point to aim for when we're bringing together that trio of complexity, speed of decision, and the need for governance.
And so, sorry, just to follow through on that a little bit. So, what does explainability mean in that circumstances? Who's doing the explaining, I guess?
Well, it means fundamentally humans being able to understand and explain why a decision has been made. I don't think that being in a position of not being able to explain the rationale for our trades or positions other than, the model told us to do it, I don't think that's a tenable one. So when I think about explainability here, I think about being able to take an individual trade or a position in an instrument and trace back all the way upstream why that decision has been made. And data like lineage, that's increasingly becoming a first order concern, understanding where data's come from, what transformations have been applied to it, and what decisions have been made off of the back of that data. That's what I mean by explainability.
Yeah, I see. Well, I think I see. Yes, I get the rough idea. So, just to sort of maybe just to sort of finish up. I mean, talk a bit about the sort of about this from a regulatory point of view. I mean, I think financial regulators obviously it's their job to worry about things, and this is something new for them to worry about. Or actually, they've probably already been worrying about it for a while, but there's more focus on it, and therefore more reason for them to worry about it. I mean, I think we can think about the sort of the sort of firm level kind of questions for a regulator in terms of, is this being properly, the things you were talking about earlier, is this being properly overseen? But some of the regulators are also thinking about the possibility that these technological developments lead to sort of unusual events in markets where, for example, maybe models will do the same models that had all been trained on the same data all do the same thing, or something like that. Is that something? Is that a legitimate concern, do you think?
I think I take somewhat opposite view on this one. fundamentally, this is technology that helps us drive innovation. It helps us deal with a bigger and more varied, rich set of data. It helps us come up with and implement new ideas. And overall, this should mean increased diversity of models as opposed to concentration amongst them. That's not to say, of course, there are like no risks here. I mean, depending on where an algorithm is sitting or what it's doing, in a rich multi-strat portfolio, for example, we could imagine a very large number of models being brought to bear and very much diversified risk amongst them. I think perhaps where I take a slightly different view is algorithms that are sitting that perhaps have a concentrated capability to do serious harm or cause significant market disorder. I'm thinking perhaps more in the market making space here. But other than that, I think the case is weaker, and the key is having like robust controls, robust engineering practices, and strong investment risk. They're a better form of safety, I think, overall, and should assuage concerns, regulatory concerns here.
And that presumably also means having a certain amount of transparency and back to the word you use, explainability.
Yeah.
Not just within the firm, but also to financial regulators and others on the outside.
Possibly, yes. Particularly for those areas where I think there's this concentrated capability to do harm if things go wrong.
Yeah. That's really interesting. Just to finish up, then maybe Gary, just what sort of immediate developments over the next year or two are you most excited about? What's taking up most of your time?
In tech in general, or in the AI space in particular?
In the AI space.
So I talked about our Alpha GPT project a few minutes ago. That's the thing which has really piqued my interest most acutely here. That seed of something which could fundamentally disrupt the way we've operated as a firm for a long time now. And if we can start to leverage our investment professionals even more highly than we can today, then that's the thing that frankly excites me most at the moment.
Okay, well, this has been fascinating. So thank you very much for your time, and we will check back in a year or two and see where you got to. But
awesome.
But for now, thanks very much, Gary.
Thank you.
That's all we have time for this week. This podcast was produced by Oliver Taslich in London. You can listen to a new episode of The Big View every Tuesday on the Reuters app or your favorite platform. Don't forget to tune in to our sister podcast, Viewsroom, every Thursday, as well as the other great podcasts from the Reuters team, Reuters World News, your daily dose of the global biggest stories, and Reuters Econ World, a weekly deep dive into an economic concept behind the headlines. If you like what you heard, please follow The Big View and let us know what you thought. And check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.